Hey everyone, just quickly wanted to introduce Valery. Valery.ca is Canada's first AI-powered real estate brokerage. And the reason that we're doing these calls is that it's our job as a brokerage to be of service to realtors, and we want agents to have the best understanding of the real estate market that we possibly can, which includes what's happening in the economy, what's happening in each of our local markets and with the national real estate market, what's happening with monetary and fiscal policy, and how these factors could impact the real estate market and the buying and selling decisions of our clients. If you're in the GTA, which I think the majority of people on this call would be, you might be experiencing something called seasonal effects disorder from a lot of the record snowfall we've been having over the last couple of days. I thought this was an interesting time to add in a chart from the C.D. Howe Institute that shows how happiness is declining in Canada on a general basis, especially among young people. So people below age 30 are actually at a record low happiness score for Canada. And we dropped from 5th in the world to 15th since 2015, so in the last 10 years. That was just my fun fact for the presentation for today. Maybe not so fun because it's kind of depressing, but quickly, the agenda that I'm going to cover this week or this month, we're going to go through tariffs again, a little bit more in granularity and how it could impact different markets across the country. Going to talk about the employment, since to me that's the biggest focus of the most prominent headwind for Canada's economy right now. And then we'll talk about the housing market and potential path for interest rates. So start off on the tariff side of things, a little bit of a change from last week where we assumed we were getting blanket tariffs. It seems like Trump has settled just on steel and aluminum tariffs. The problem being, that was steel and aluminum tariffs for everybody around the world. The problem is that Canada is probably the biggest victim of steel and aluminum tariffs, which with us being the largest supplier to the U.S. of both of these metals. That being said, the trade balance isn't as bad as it has been in the past. Next one here is that the U.S. output is low. So they do depend on our steel and aluminum quite a bit. And so this is actually probably more likely to have a negative impact on the U.S. consumer, who is going to absorb those higher prices from tariffs, rather than Canadians who will just see the steel and aluminum industries contract instantly. They're also long supply chains. Like, you can't just build an aluminum smelting plant tomorrow. And they're also incredibly energy intensive. And so it's probably not going to have an immediate impact. If it sticks around, it could have a longer and drawn out impact. And obviously you will see impacts on two cities, most notably, obviously, Steel City in Hamilton, Ontario, and Saguenay, Quebec, which is also known as Aluminum Valley. And for anybody who's looking for more information on this, we actually just did a podcast episode on the Canadian Real Estate Investor podcast. Nick and I recorded a couple of days ago, and it'll be out within the next few weeks. Actually, it should be out this week. I can't remember exactly. I'm just going to try and check on the comments here. So the other piece is that Trump's also threatening auto tariffs in April. This would obviously have a big impact on the GTA with, you've got Ford in Oakville, you've got Oshawa, Ingersoll, Alliston, Windsor. So a lot of exposure to Ontario. Which, if we take, it seems like he's kind of serious about this like 51st state thing. And if we take his objective seriously, what would he do to try and accomplish that goal? It would probably be to sort of really attack the economic center of the country. And that would be I think the Ontario first, and then the auto sector probably being the main line to it. Similar to steel and aluminum from my perspective, actually probably even more so. Not easy to just move to another country. So do I think it's a super big threat? Yeah, if it's executed, but the likelihood of it being executed is pretty slim. You're already seeing calls from all of the large automakers in the U.S., basically saying that this would increase car prices and tear a hole in the side of the auto industry. The one thing we do have going for us is that autos are second largest export, I guess. So you look at the two that I just mentioned, auto and primary metals. Those are number 2 and 3 for exports from Canada to the U.S. Oil and gas being the largest, and oil and gas is only subject to a 10% tariff at the moment, and the U.S. depends heavily on that. So, Canada's economy could just become more dependent on oil and gas. The Canadian Chamber of Commerce put out a really interesting analysis on this, and this was back when we thought tariffs were going to be about everything. And they basically analyzed which cities have the highest exposure to the tariffs as they were originally proposed. And so these are cities where there's a high U.S. export intensity. So the most exposed, I'll go to the list, but you can see on this chart kind of like anything past this line, this dotted line, is places that trade more and export more to the U.S. And then the height of that line is the percentage of that area's GDP relative. So Calgary, St. John, and Windsor are the 3 most vulnerable. Calgary being exporting the majority of their oil and gas to the U.S., Windsor auto parts to Detroit, and St. John is actually, this one surprised me, and I didn't really know much about it, but the Irving oil refinery, Canada's largest oil refinery, is in St. John, and so Canadian oil that gets refined and shipped to the U.S. is all done there. So if you look at this kind of in a different visual, you're probably going to want to see what your city is, or where your city is. The outside of the St. John and Calgary, there's a lot of Ontario exposure to the top 10 here. So you've got Hamilton, Guelph, Brantford, Kitchener, Cambridge, Waterloo, which is 3 cities. And so a lot of those are Canada's manufacturing heart, where we're exporting a lot of products to the U.S. Obviously, real estate is a very local story, and so this is a really important visual for you to familiarize yourself with, to get an understanding as this tariff threat looms. I feel silly, like, even kind of talking about this over and over, the tariff thing, and it feels like kind of beating a dead horse. But the reality is, it keeps coming up, and it's likely going to keep coming up the same way it did in 2016, 2017. And during that period of time, we did see like a slight recession and some corrections in interest rates in Canada and the US, and maybe not a recession per se, but definitely some GDP contraction. If you want to look at it from a map visual, again, this all comes from the Canadian Chamber of Commerce. You can find it on their website. These are the areas. So you can obviously, again, see a pretty heavy concentration in Southern Ontario. This is from RBC Economics, and they really felt that the tariff threat is going to probably end relatively catastrophically for North America's economy, with Canada and Mexico producing a substantial amount of U.S. manufacturing imports. So basically, if you're a U.S. manufacturing company and you need inputs, let's call it, like, if you're a car company and you need to import mirrors or pistons or whatever, anything that goes into a car, a lot of them are coming from Canada and Mexico. Canada especially, with like we have Magna here, and a bunch of other companies like that, and so tariffs, like, there's a lot of components to vehicles that get made in one place and then shipped across the border and then shipped back to Canada and then back to the US, et cetera. And if they're getting tariffed every time, which is in the original spirit of the tariffs, that's actually how it presented. It's no longer the case, but that would become, it would have a huge cost push inflation to the consumer, which is the major concern for the auto industry. And that's why they're really pushing back on it. All of this is, it kind of scares me a little bit, just given that our unemployment rate is also still rising. I guess it did kind of flatline a little bit in December, but so it backed off a little bit. But I think a lot of that is, as Ben Rabideau mentioned, because the StatCan is overestimating how how many people are leaving Canada based on the new temporary foreign worker and international student policies. And so, looking a little bit closer at it with the Bank of Canada, this is from the Bank of Canada's monetary policy report in January. They felt that the unemployment rate has risen mainly because people who are unemployed already are having a hard time finding jobs, but we're not seeing a lot of layoffs taking place yet. One of the places I've really been watching this is construction job vacancies, which seems to be tracking total job vacancies. And this comes from PH Floor on Twitter, who's one of my favorite accounts to follow, and I would recommend checking them out. But basically, I thought we would see an outsized increase in construction jobs declining as we're seeing a lot of these projects wrapping up. It's not the case. The reason for that is, we still have a huge residential development pipeline in the city of Toronto. Even though you get a lot of these projects that we're hearing are not pre-selling, the ones that have pre-sold are still building. They're long projects, and you can see, like in the downtown core, there's a ton of built or active projects. A lot of the red and the yellow, green. A lot of the projects under review or that are proposed probably won't be seeing those taking off anytime soon, because those are the ones that you're kind of thinking, okay, those are going to be the failures to launch that won't end up as units anytime soon. But all the red and the yellow is still your construction jobs taking place. And similarly, you've got a lot of non-residential development taking place in the city of Toronto. And so the construction industry has still been relatively strong, even though I've been hearing a lot of rumblings that it's beginning to suffer. Statistics haven't yet pointed to that. New construction is expected to slow over the next little bit. This is from CMHC's housing outlook for 2025. So they're expecting construction to slow 25, 26, 27, back to basically 2023 levels, somewhere between 2020 and 2023 levels. So again, we did see a lot of new construction at a national level in between basically during the pandemic until like 2024. And they're expecting that to slow down, but not to levels below kind of what we saw before not to the levels that we saw before the pandemic. This is kind of important consideration because while this means this is a good thing because construction people are still employed and housing supply is getting built, it also means that housing supply will be getting built, which means that house prices might have a hard time growing. And we're starting to see kind of how CMHC could, how they're sort of modeling the growth of Canada's economy based on that. Their low scenario being obviously a pretty scary one. I don't think we'll see anything that extreme, but I don't think we'll see, I would say probably the medium and high would be unlikely as well. So I think you're probably gonna end up somewhere in the middle of that bottom blue line and the gray line above it. We are seeing inventory really beginning to pile up in resale homes in Canada. This is pretty simple. Like most of you as real estate professionals would be able to observe this. We're seeing more and more supply. I'll show you a couple of new graphics on new supply. But so you're seeing new listings increasing. You're seeing more new listings each month than sales. And so, every time a new listing fails to sell, the next month it's still there. And so, it piles up as your active inventory. So if we don't see demand pick up significantly, which it seems to be kind of like pausing a little bit with these tariffs and economic uncertainty. If we don't see demand pick up, I would say that we'll probably be pretty firmly in a buyer's market for most of the year. That's my expectation as it stands right now. I just think that supply is coming on the market a lot faster than demand is. And even with interest rates coming down and buying power being resurrected, I think a lot of people are really more concerned about like jobs, the security of their employment rather than the monthly mortgage payment or the interest rate that they're paying on their mortgage, et cetera. I think Tiff Macklem famously said in his interview in 2021 with Pierre Polyev, what Pierre was grilling him about how much people could withstand increases in interest rates. And Tiff didn't seem exceptionally concerned about it. And it appears that he probably was right because we haven't seen a ton of increase in mortgage delinquencies as a result of rates going up. But he did say that the biggest reason that people stop paying their mortgage is because they don't have a job. And so I think unemployment and fear of unemployment are going to be the biggest headwinds for the market right now. And that's why I think demand will not grow at the rate that it typically would or should as rates come down. And supply is obviously growing at a much faster rate because you're starting to see people, it's a negative wealth effect, right? People are trying to sell stuff to get in a better cash position, feel more comfortable, et cetera, because the economy just isn't feeling that good. Another place that we kind of see this is you start seeing a big exodus of folks from cities like the Torontos and Vancouvers, which are kind of your red and gray lines here, to cities like Calgary and Edmonton in search of affordability. Again, downsizing your lifestyle, trying to maintain, downsizing your expenses and trying to maintain the same income. So Calgary, obviously, just massive growth since 2001, 70% growth compared to like kind of your 30% from cities like Toronto. Going to go over the national market outlook now, just some charts from RBC and CREA, the Canadian Real Estate Association. So what I mentioned in regards to the interest rate impact is affordability rates can only do so much to improve affordability. And there's a limit to how much they can do because of the stress test. So right now we're, at, let's say 4% rates. So people are getting stress tested at 6%. And then if rates come down another 75 basis points, which I'll get to what the banks are forecasting, but most are forecasting at least that. Once you're down 75 more basis points, then you're at the next. So remember the B20 stress test is either 5.25% or your contract rate plus 2. And so if your contract rate today is 4%, you're getting stress tested at 6%. If your contract rate in a year is 3%, then you're not getting stress tested at 5%. You're getting stress tested at 5.25% because it's always the greater of the two. And so any reductions in rates that we see more than 75 basis points from here won't actually materialize in an increase in buying power in the market. So again, there is limited impact that interest rates can have on the downside. And so, the way that affordability typically corrects, and I mentioned this in last month's call, was you'll see house prices come down first, which we saw already, down 20%, let's say 10 to 20%, depending on the market. So that'll give you some improvement in affordability. Then you'll see rates come down, and that's given us a little bit more improvement in affordability. And now I think the bigger challenge is the only way that you can get more housing affordability on a monthly basis based on mortgage payment as a percent of monthly income is increasing your monthly income. And so wage growth would really have to be the main driving factor that would push a market up. And it's just hard to imagine wage growth. So we're already seeing wage growth softening, but it's hard to imagine wage growth really increasing when you're seeing unemployment rising. RBC did forecast that activity would pick up as interest rates ease further, which is the case. We are seeing house sales volume go up compared to the last 2 years when housing was really unaffordable, when prices were high and rates were high. But it's not going to get to the levels that we saw in 21, 22. And the only reason that it is higher is because, again, people can afford to buy houses. I think economic uncertainty will pull that a little bit of that away, but generally you should see people buy more houses as they can start affording to buy houses again. RBC does expect house prices to post a bit of a gain this year. And this is a really important distinction is I wouldn't actually disagree with them. I think that we will see that. I think they put it at 1.9%, so just shy of 2%. But the important key here is that inflation is 2%. And so when we look back at the 1990s, there was a period of where house prices fell or kind of grinded down from 1989 to 1994. And it took until 2002 for house prices to get back to their nominal peak. Nominal means just the dollar value, not adjusted for inflation. If you adjust that for inflation, you get what's called a real house price increase. And in order for real house prices to get back to their 1989 peak, it took until 2012. And so from my perspective, even if you're getting these annual gains of 1.5%, but inflation is 2 to 3%. And again, tariffs are inflationary at the kind of before they start demand destruction. They are typically inflationary. Like trade war would be inflationary at the onset, and it would gradually become disinflationary. So if we end up in an inflation environment, then again, you are seeing inflation regardless of what the Bank of Canada does, because it's not like they can make tariffs go away by reducing the interest rate. If we end up with inflation in a 2 to 3% range, or if inflation is 3% over 10 years, that's a 10% larger increase in prices of stuff, of goods, or 10% larger impact of inflation than if it was 2% over 10 years. And this is really where housing it has a hard time being a provider. And this is where you kind of shoot yourself in the foot by relying on housing to run your economy like Canada does, is when most people's wealth is tied up in their houses, and inflation is outpacing the gains in our house prices, the economy, or the average person's wealth, isn't outgrowing what inflation is. So this is a big challenge for Canada. So while I do think that house prices will probably grow for 2025, I don't think that it'll outgrow inflation. And I think that that's probably we'd almost rather that they fall, or people start rotating out into assets that are inflation hedged rather than housing. Just back to the listing side of things. So January, if you were to measure its quarterly volume, it's pretty much the highest month of listings we've seen since the onset of the pandemic, of new listings in Canada. So this is substantial. Like, I mean, even during those peak periods when everybody was kind of rushing to try and sell to lock in gains when the market was hot, we're still seeing a stronger January for listings. At the same time, sales are low, right? They're not that much lower than if you look at the last couple of quarters worth of data, but they are lower than Q4 of last year. Again, January, it's tough. Like these are seasonally adjusted. So because it's typically it's hard to use January because it's December and January are usually your slower months. So what this means is that your residential market balance, so your sales to new listings ratio and your months of inventory, residential market balance has basically fallen significantly. So your sales to new listings is now below 50% again, and your months of inventory is beginning to climb again. And so we went from a market that looked like it was moving in favor of sellers to a market that is immediately flipped in favor of buyers. And I think a lot of that does have to do with the economic uncertainty. Prices, I've mentioned this since honestly 17, that basically once we saw a big drop, we would see a flat market for several years, and we did see that in 2017. When I saw the peak coming in 2020, 2021, I said, after this, you'll typically see like the 80s, you'll see a big steep drop, or sorry, 90s, you'll see a big steep drop, and then basically the market will it'll bounce up and down, but it'll trade sideways. And we've pretty much seen that. And if you're to draw a line from the bottom of this chart to the top, you would see that we've almost returned to the mean. I do still think there's more downside risk. You can go below the mean trend line, but one of the ways to get back to your long-term growth trend line is to just trade sideways. It doesn't have to kind of crash back down to catch that line, because then it would just start growing again. It could just trade sideways, especially if you have sellers who have a lot of padding, who have equity, who aren't in a hurry to sell, and that is how I would characterize Canada's market, where you have a lot of property that's controlled by baby boomers who basically are completely independent of what's happening with, the economy, inflation, et cetera, because they have millions of dollars of equity in their homes. National sales are back below the 10-year average. And so again, we spent a long time below the 10-year average. We shot back up above it. People were feeling great. We're kind of back below that, and this is it again. So these are the periods of time where you really do feel it in the real estate market, where realtors suffer. Buyers and sellers don't really care, but real estate professionals suffer from the fewer transactions. I'm going to zoom in on Toronto now, just to examine whether or not we're kind of seeing a similar supply phenomena. And I'll touch on interest rates at the end. So for anybody who doesn't want to listen to the downtown Canada report, you can just plug your ears for like a minute. But basically, we saw what I would call a relatively high new listings volume. This is weekly new listings. So you can see 2025 is about the same as your 21 and 22, which were strong spring markets from a listings and a sales perspective. We don't have sales that are keeping up with the new listings, but this would be pretty high compared to your kind of 2018, 19, 20 and 2023, 24, which are more typical markets. So this isn't some kind of market where you want to be seeing a ton of supply. The other thing I would say is that if you look at every red dot on this chart, it's typically followed by, I don't know why this happens, but it does almost like pretty predictably. February 5th week, you see a big jump up in listings. And then the week after, you typically see a little bit of a drop in listings. And then you see a big jump up heading into the end of February and early March. And so I kind of just modeled where I think this would go from here. And I do think we're going to end up with a pretty high supply spring market. We hear a lot about like price growth and people complaining that prices are relatively unaffordable here. But if you look at relative to real house price growth, so again adjusting for inflation, you go back to 2020, Canada is actually kind of the middle of the road compared to the rest of the G7, with the US being significantly higher. A lot of this does have to do with the fact that we ran a much higher inflation rate than everybody else. And so again, I would argue that a lot of the gains that we've seen from house prices came from us being in an inflationary environment, to the point where we actually are below, adjusted for inflation, we're below our 2020 house prices at a national level. I think the last two slides here basically just interest rate forecast from RBC and then all of the other banks. RBC obviously forecasting that we're going to see further cuts and there what appears to be substantial further cuts in interest rates, basically getting us all the way down to your 200 basis point overnight rate, and they expect that the 5-year bond yield will kind of follow, but stay higher in the spread. Whereas we're kind of just getting to that point where the 5-year bond yield and the overnight rate are touching one another. And just to look at this compared to everybody else, so RBC does have the lowest terminal rate, so the lowest kind of cutting rate on the cutting cycle that they think, with CIBC and National just slightly higher. Scotia, I think Scotia modeled an inflationary outcome from the tariffs. I think I put that in last month's report. And so I would assume that Scotia, thinking that we'll see a 3% overnight rate, which is no change from today, basically we're done cutting, would be that they expect that that inflationary impact from a trade war will take place. But pretty much everybody else is 2 to 2.5% overnight rate, which is kind of where I think that will ultimately end up. I'll caveat that with, I don't think it's going to do any favors for the market. I think that unemployment and economic uncertainty are going to be the true driving factors for the housing market in 2025. And so I would really be paying more attention to that. And you can do that in a qualitative way, right? Like you don't have to just look at the unemployment rate like I do. It's like talk to your clients about their, or just, you don't have to go ask them like, hey, are you worried about losing your job? But you can listen to what they have to say about employment certainty. Are they hearing about layoffs at their company? Are they hearing about layoffs in their industry, et cetera? And that really will give you a kind of, that's something that you can't get from doing what I do or doing what economists or banks do, which is really just like a boots on the ground perspective, or like a finger on the pulse of the market. That qualitative layer of data is really going to give you a good perspective on like what market sentiment is like and what you can expect probably from the market even earlier than I can interpret it with data. So I would really be paying attention to that, is what people are seeing from an employment uncertainty perspective, and kind of where their sentiment is heading into the spring market. So I'll leave it there. And if anybody has any questions, I always love to answer questions. So hit me. I'm going to just try and browse the comments here or the chat here, but no. I'm going to assume that means that I explained everything well. I'll just go through, address a couple of these things in the chat here. The banks' mortgage portfolios are all coming up for renewal, and mortgage payments will rise 60 to 80% and will likely impact delinquencies. Vishal, this one, it's technically only 60% of mortgages will be renewing with a higher rate than before, because we had all those people who signed up for rates from 21, 22, 23, 24 for like the 1, 2, and 3 year mortgages. So you actually get a lot of people who are renewing with lower rates as well as people who are renewing with higher rates. You will obviously see a lot of stress entering the market from the people whose payments are going to rise, but it's a shrinking portion of the market, and the severity of the payment increase is not. I actually don't think there's any scenarios where there's a 60 to 80%. It'd be really hard. Anybody who's seen a 60 to 80% increase in their payment has probably already seen it from they're on a variable. I mean, if somebody's on a fixed, the math on that, let me just think, like if somebody's on a fixed at like the lowest fixed I think I ever saw was like 1.5, and they're renewing now at a 4, their interest is going up 100%, but your interest is, if you're also going from, if somebody was doing that, they're going from a 5-year, so they'd be rolling into if you're, assuming you're 5 years less on your amortization, so your principal payment goes down, your interest ends up being like a third of your, maybe 2/3 of your mortgage payment. So that would end up being like kind of a 30 or 40% increase in their mortgage payment. Probably less likely 60 to 80%. Regardless, 30 to 40% increase is a substantial increase. Peter G, inflation hedged assets. Phil answered pretty well. Gold, bonds, I guess, but you do see a rotation into bonds. Government credit. A lot of people will feel like Bitcoin is kind of a inflation hedged asset, because the more central banks print, that the more it kind of strengthens the resolve of the Bitcoin thesis. I think that the land portion of real estate is decent, and I actually think that houses are somewhat inflation hedged as well from a rental property perspective, like a productive asset. But housing is a cost first, right? So like a house, if you're just selling a house as a speculative asset, then you're selling a liability to another consumer who needs a house and a mortgage to a house to live in and the mortgage to pay. And so that would be vulnerable to inflation rather than benefiting from it. If you own a rental property, and maybe you're adding a unit to it or something like that, then you kind of lock in today's construction prices and yield those costs away through rent. It's a little bit of a different scenario. So you just have to kind of divide real estate into primary residence versus rental property. Vishal, I agree with what you're saying in the chat. Like the 1.8x is actually is debt to disposable income. I would agree the 40% increase is substantial. I was just saying that it's not 60 to 80. Fozan, the home price increases in Canada after adjusted for inflation compared to other G7 countries. Yeah, let me pull that slide back up again. So basically, this is Canada compared to the other G7 countries and the Euro area. So basically, in 2020, all of the house prices start at the same point, because you're using an index, not an actual house price. So you assume whatever the house price was in 2020. Let's assume it was $1. In Canada, by 2022, if you look at the peak, then it was up to $1.25. So it had grown 25%. And then it fell after that. Both house prices fell, but also inflation was running hot. And so again, this is relative to inflation. So this is adjusted for inflation. And now the combination of house prices falling and inflation inflating away a lot of those value gains from 22 to present day makes it so that house prices are actually lower on an inflation adjusted basis than they were in 2020. Compare that to the US, where house prices are basically the same as they were at peak relative to inflation, and significantly higher, 20% higher than they were in 2022. And then you can look at, again, like the UK, where they're higher than Canada relative to inflation, and the Euro area just barely, but higher than Canada relative to inflation. I hope that that clarifies there. For Marco Perusa, I would say that I think that you're going to start seeing the government become more involved in housing creation, but also infrastructure. And again, I think it's really important to watch this. So the question is, what additional federal funding initiatives could help bridge the national housing gap? To be honest, I actually don't think we have a housing gap anymore. I think that the resale market, I was never super convinced on the supply narrative, but now all of a sudden that we've realized, like now, supply mattered when population was growing at 2 or 3% per year, and it seemed like that was going to happen forever. That's not happening anymore. Population's growing at 1%, maybe max. This year probably will grow at 0.5%. So you have 3 to 500,000 permanent residents being added to the population, and then 2 to 500,000 non-permanent residents who, again, are non-permanent. And we're seeing now with the students, temporary foreign workers, et cetera, that a lot of those folks are leaving. And so you're actually seeing population contract, or at least population growth slow. I'm not fully sold on there even being a national housing gap. I'm still going to answer your question, but I'm not fully sold on there even being a national housing gap as it stands right now. The rest of that, again, if you're pouring water into a sink, right, some of it'll spill out, right, once you hit the top. So the water spilling out is like people going to Toronto and then they're leaving. They're going to Calgary or Halifax or whatever, because you ran out of space for them to affordably live in the city of Toronto. So that's kind of solution number one that we've already seen take place. Solution number two is what if the water is actually mud, right? And you can actually pack it in tighter. And that's kind of what we're also seeing, which is, young people choosing to become roommates or stay with their parents longer. So you're seeing the average household size growing. And those are probably the two ways that demand is a lot more liquid than people want to imagine. It's not just oh, you have two people and now they have to go and buy a house and live together. It's well, no, we know that Canadians' standard of living is suffering, right? We know that our GDP per capita is falling, although it might be growing again now, and we might see a lot of these things start to change. But if GDP per capita is falling, what's the biggest expense that Canadians have on a monthly basis? It's housing, right? 30% of our income is the recommended. It's probably closer to 50% of our income that we actually spend on housing. And so if we're spending all of that money, or we're spending such a big portion of our income on housing, and our income shrinks, what's going to feel the impact of that income shrinking the most is housing. And so that's where you're seeing more people moving into houses, square footage per capita shrinking, and just the quality of housing for Canadians is in decline. You saw this happen in places like the UK, the US, et cetera. We're just next on the block for it to take place. All of that being said, I do think that we'll see, Carney mentioned that he wants to run a deficit. I think that Pierre will run a deficit as well. I think that he wants to say that he's a small government guy, because that does well for votes in a conservative, in a market where you have a kind of a more conservative mentality, and you're seeing people have less and less trust for government, and less and less in favor of bureaucracy. But it's not that simple when you'll be inheriting, assuming that Pierre wins, you'll be inheriting a recessionary economy with a lot of those construction jobs ending. Like I mentioned, I could see a lot of make work projects. If you go back and look at the 70s, there was a lot of the brutalist architecture that we see in Canada, these like big concrete, like Robarts Library, or like you go to any university campus or main city and you see like these big concrete structures. Those were all built from this, like what they call a make work project during, I think, the 70s or 80s recession that was designed to use Canadian concrete and Canadian labor, et cetera. So I could see, and I mean, God knows we need better infrastructure in every city in Canada, but especially in the GTA. So I could see a lot of those like construction shops being retooled with federal capital to, build hospitals. We've already seen like there's billions of dollars of bidding out for hospitals right now. Public schools, the same thing. There's tons of provincial public schools in the province of Ontario. Railways, subways, LRTs, et cetera. So to me, that's where you get a lot of those. And I don't think the money will go into housing directly. I think our current housing model with CMHC, their MLI Select, and the ACLP program is getting enough housing built. I think it's getting actually maybe too much housing built. I think we're starting to see markets like Alberta maybe being overbuilt, and CMHC is kind of clawing back a little bit of that capital and changing some of the restrictions because it's starting to be abused, which I'm sure many of you on this call are familiar with. Like there's definitely a lot of fun stuff happening in that CMHC MLI Select space. So my expectation would be that more federal funding will go to infrastructure than housing. I hope that answers your question, Marco. That was a really long answer to a very short question. I apologize. Anybody else in the chat? Doesn't look like it. Okay, I guess we'll leave it there. As always, Valery will send out a recording of this. If you're a real estate agent and you want to learn what it's like to be part of Canada's first AI brokerage, give me a shout. I'd love to hop on a call with you and just kind of chat through what that looks like. You'll get an email with the recording and key points from this as well as an email to sign up for next month's call. If you have any specific questions or data points you want me to cover for next month's report, I would love that. So just send me a message either via email or probably Instagram is the easiest platform to reach me, to be honest. And I'd be happy to have that conversation with you. Have a wonderful week and enjoy the snow.